What's going on, Invest Maniacs? Your boy, a Night Rider here, and today we're talking about Pfizer and Chesapeake Energy. Up first, we've got Pfizer. Oh, big pharma. Don't we all have that love-hate relationship with them? They create drugs that save our lives, and then we die penniless paying for it. I don't know about you, but hey, I'd rather be alive and penniless than dead and rich. Despite having a lackluster stock performance year to date, trading mostly sideways, there is reason to be optimistic. Plus, Pfizer is paying you that bountiful 3.3% dividend while you wait. This month, Pfizer declared its plan to purchase Array BioPharma for a whopping $11.4 billion. Array BioPharma happens to own the rights to 2 approved treatments of cancer. The deal was Pfizer's largest acquisition since biotech company Medivation back in 2016. But if these cancer drugs work out as they are hoping for, they will be blockbusters. I'm not really sure if that's a term I should use anymore. Blockbuster. I don't know. Kind of implies like it's going to go bankrupt or something. Anyway, Pfizer recently received FDA approval for a rare heart disease medication, Vyndaqel, and Vyndamax, which is just like a higher dosage of Vyndaqel. They're used to treat an unusual protein called amyloid, which accumulates in the heart. Pfizer can now literally mend your broken heart. Aww. While the valuation of Pfizer is fair, trading at 22 times earnings with 19% annual earnings per share growth over the past 3 years and a healthy 3.3% dividend, I would like to see who wins the Democratic primary before I drop any additional money into the biopharma space. Up next, we've got Chesapeake Energy. Despite being relatively universally panned by analysts, trading volume continues to be in the tens of millions of shares daily, and some people think the company is capable of a Hail Mary earnings report. While oil companies always have that potential to strike a vein in the earth which will bleed oil, this is more akin to throwing your money on the roulette wheel than it is a sound investment strategy. Chesapeake Energy made a bold entry into the publicly traded oil and gas sector a little over 25 years ago, with Aubrey McClendon, its charismatic co-founder, as the company's public face. Chesapeake bought the then new concept of fracking into the mainstream vocabulary. After a setback in the mid-90s, Chesapeake rode high for a while on global increase in natural gas prices. The first rumblings of trouble sounded in 2012 when McClendon was forced out of the company after it was discovered he was using personal holdings in some gas wells to get financing for Chesapeake. Soon, the company began shedding many of its assets and laying off many employees. In 2016, McClendon died in a one-car accident the day after a grand jury indicted him for antitrust violations during his tenure at Chesapeake. During its heyday, Chesapeake traded mostly in the $20 to $40 range, reaching a peak of $70 in 2008. It has since been on a gradual decline, losing over 97% of its value, currently trading at $1.88. Chesapeake has sold off a lot of its assets to lower the company's debt load. Last year, CEO Doug Lawler reported, quote, "We have decreased our total debt load and leverages by more than $12 billion, eliminated legacy commitments and obligations by more than $10 billion. This is Lawler's home, by the way, not too shabby for a dude who oversaw a 91% decline in Chesapeake's stock price during his tenure. Chesapeake continues to cut the cost of developing wells and the time it takes to bring wells online, and it increased its oil playbook with the acquisition of Wild Horse Resource Development Corporation in 2018, which just kind of settled this year. The addition of Wild Horse continues the company's diversification away from natural gas and into oil. By late 2020, Chesapeake plans to up oil to 30% of its production from its current 22%. Should you be in Chesapeake? While the company has had profitable years, much of this is due to the sale of assets. Free cash flow will really tell you how the company is doing, and the company has been free cash flow negative for over a decade. The company has an accumulated deficit of $15.6 billion and holds over $7.7 billion in debt. This is just the long-term debt. There's a little bit more in short-term debt. If the company liquidated itself and sold off 100% of its assets, it would still be over $12.4 billion in the hole. Chesapeake is a popular stock with millennials, probably because the share price is so cheap, under $2, and because the financial statement is a little misleading since it shows profits. But of course, I would recommend you stay away. I hope you guys have a great day, and may the market be ever in your favor.